Welcome to Trading Nation. I'm Brian Sullivan. According to Bank of America Merrill Lynch and a fund survey they did, the NASDAQ is considered the most crowded trade right now, maybe in the world. Everybody is out of the long dollar trade and into buying tech stocks. What does this mean for you and your money? Joining us now is Dan Niles of AlphaOne Capital Partners. Dan, it's a real pleasure to chat with you again. Thanks for coming on Trading Nation.
Always a pleasure, Brian.
You know, it's interesting because I think the first time you and I interviewed was probably at the tail end of the longest bull market in history from 1990 to 2000. This is the second longest bull market in history. We all know how the first longest bull market run did. It didn't end well. It produced about a 46% downturn overall in the markets. Do you think this bull run will end the same way?
You know, I want to believe the answer is no, but the longer it keeps climbing and the higher valuations go, the more nervous I become. And, you know, to your point, you and I think, first did talk in the late 90s, and I remember in 98, the market looked expensive. And, in fact, if you look at the Cape-Shiller ratio, it's about where it is, you know, today, which is about 29 times. And then you got into 1999, and the NASDAQ went up 86%. The S&P went up 20%. And, you know, it made those valuations look pedestrian as the valuation went from, I think, 29 times to 45 times. So, you know, that could happen. It's like you and I were joking about earlier. I mean, the Patriots could come back from 28-3 down to win the Super Bowl, so anything is possible. But that's not necessarily, you know, the high probability bet to make, I think, at this point.
Do you think it's funny, too, because the names are all different, Dan. I mean, back then we talked, there was names, a lot of them that don't even exist anymore. Commerce One, Ariba, you remember these companies?
Oh, yeah.
Now you've got everybody.
Yeah, but we do have Snapchat now.
Yeah, well, but that hasn't done as well. I mean, you've got the number I threw out on my show Power Lunch today was that 5 stocks make up 40% of the QQQ ETF: Facebook, Amazon, Alphabet, Microsoft, and whatever the fifth one was. I couldn't remember, but you get the point. Is it risky that everybody's going into the same things, or
well,
appears to be?
Put a different way, and I think this is relevant. The 5 biggest companies, I believe, in the S&P 500, they account. They are as big, I believe, as the bottom 1,500 or so in the S&P 500. So, you know, this market is very concentrated, to say the least.
Yeah.
But I think you do have to look at the individual names within the market. So, you know, there are names within there that I look at and I say, okay, you know, when I look at a Facebook, let's say, which crushed numbers yet again, or Google, which crushed numbers yet again, and you look at the growth that they're doing. So, you know, Google's growing revenues at 20%. You've got Facebook growing revenues at close to 40%. You can say, well, I can pay 28 times for Google, and I can pay roughly 31 times for Facebook, or I can pay 18 times for the S&P that's got 6% revenue growth. So, you know, when you compare the growth rates of some to the multiples you're paying,
yeah,
you know, it doesn't look that bad. And this is nowhere near, as you and I just talked about, 2000, where you had stocks, you know, selling pet food on the internet that were worth billions of dollars.
Yeah.
Right? So these are real companies. And so a downdraft of similar magnitude is hard to imagine unless the market kind of keeps expanding. But, you know, we're long overdue for a big correction, right? This is the second longest bull market since World War II.
It's healthy,
right?
I mean, people, I know,
correction every year, and we haven't gotten one for
CNBC is often accused, oh, you're the market cheerleaders, you just want stocks to go. You know, I'll just be on the record as one person at the company saying market pullbacks are healthy, are they not? I mean,
oh, yeah,
going up every day in a narrow, tight range over time, I don't know. It may turn out to be perfectly fine and healthy, Dan. I don't know if it is. I start to get a little worried. Oh, and it's no knock on Amazon or Google, but the fact that so much of the market is those stocks, not even directly, even indirectly, people just buying ETFs, that if those stocks begin to fail, won't it then possibly take down the whole market? Even if the underlying strength is good, if those 5 stocks turn around, won't that then do the inverse of what it is doing now? I don't know.
Yeah, and I think that's a valid point. Quite honestly, I'm not as worried about the internet companies because here you're talking names that are growing 20% plus. So if you can think about it logically, if they go up 20% a year, They're just keeping up with their growth rates. And in fact, if Facebook doesn't go up 40% a year, it's getting cheaper every year. Now, if you look at semiconductors, which is where I have the real problem, semiconductor index in 2016 was up 37%. The revenue growth was 2%. This year, the semiconductor index is up 18% year to date already, and the revenue growth is maybe 5%. And so you look at that space and you say, well, that's the most highly cyclical portion of tech. It's not as cyclical as it was back in the late 90s, but it's still very cyclical. And if you think about, well, what do they sell to? Well, they sell to the PC industry. Well, we've had 5 down years of PC unit sales in a row. This year looks like the 6th. They sell into smartphones. Well, smartphones aren't growing 30% like they were in 2014. Apple just missed their numbers that they just reported. And I know everybody's super excited about the supposed super cycle, which I have my own concerns about. But, you know,
that's a different interview.
That's not going to grow at that rate. We can talk about Apple later if you want. But, you know, and then you look at automotive. You know, China's auto sales last year were really stimulated by the fact that they cut taxes down to 5% from 10%. So that went ahead and really ramped up auto sales last year into the double digits. The most recent month, it went negative. And in the U.S., we all know what's going on with Ford. So you look at this, and then you listen to the semiconductor companies who are saying, oh, demand's never been better. And you think about the automotive chain, and you cannot ship a $30,000 auto if you don't have a 5-cent semiconductor chip. It's the longest supply chain that there is. So all of these things going into a summer where, you know, you and I have been doing this long enough, there always seems to be something that goes wrong in the summer. You combine that with the really long bull market, high valuations, you know, you have to be a little bit more cautious, I think. And so I worry about semis taking the market down more than I do the Internet names, because at least with Internet, you've got really strong growth and you can see it going for a while. With semis, you go, well, how do you get, you know, up 37 last year, up 18 this year when you've got, you know, 2 and 5% growth? It just doesn't make some sense.
Well, maybe we need to put the socks up a little more on the graphics screen on Power Lunch then. We will, Dan. We're going to be watching the semiconductors. A good and engaging discussion as always. Don't be such a stranger, Dan Niles. We appreciate your time. We'll see you again and talk with you again, I hope.
Pleasure as always, Brian.
Thank you. All right, Dan and I have been interviewing now. It's going on 20 years. Hard to believe. All right, thanks for watching Trading Nation. I'm Brian Sullivan. We'll see you again.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.